Greetings. Today, we're exploring a powerful tool for savvy investors. Specifically, we're going to break down how you can use 4 times your buying power by using the right type of brokerage account. Let's get started. In order to leverage your investment this way, you'll need to use a margin account. In a nutshell, margin trading allows you to borrow money from your broker to trade stocks. It's like getting a loan to boost your investment power. Instead of using just your own funds, you can use borrowed funds to increase the size of your trades. Here are some key terms. A margin account is the type of account you need to open to start margin trading. Your initial margin is the amount of money you need to put down to open a position. For example, if you're using 4 times your leverage, your initial margin would be 25% of the total trade value. Leverage refers to how many times your money can be multiplied. In our example, we're talking about 4 times leverage. Maintenance margin is the minimum equity you must maintain in your margin account to keep your positions open. Let's go through a step-by-step example of how margin trading works. Suppose you have $25,000. You want to invest in a stock with 4 times leverage. With 4 times leverage, you can control $100,000 worth of stock. First, you will use your own $25,000 as the initial margin deposit in your account. Your additional buying power will appear in your account because your broker lends you an additional $75,000. Now you're able to buy $100,000 worth of stock. If you had only deposited $1,000, after selling the stock, you would repay the borrowed from the broker. Given a 10% gain, you'd be left with $1,400 or an increase of $400 on your original $1,000 investment. That's a 40% return. Now, let's talk about the flip side. Margin trading isn't without risks. There are a few things to keep in mind. First of all, just as your gains are amplified, so are your losses. If the stock price drops by 10%, your $4,000 worth of stock would now be worth $3,600. After repaying the $3,000 loan, you're left with just $600, a loss of $400 from your initial $1,000 investment. Another risk is the margin call. If the value of your investments falls below a certain level, you might get a margin call. This means you'll need to deposit more funds to maintain your position, or your broker might sell your assets at market prices to cover the loan, even at a loss. Finally, there are interest fees. Remember, you'll be paying interest on the borrowed funds, which can eat into your profits. If you open a margin account, make sure you know how much you will be charged to borrow money. To mitigate these risks, there are some things you can do. First, understand your broker's margin requirements. Different brokers have different rules and interest rates. Second, monitor your investments closely. Keep an eye on market movements and your margin levels. Third, be sure to use stop-loss orders. These can help you limit potential losses. And that's a wrap on how to use a margin trading account to potentially get 4 times your money by investing in stocks. Margin is a powerful tool, but it's essential to use it wisely. If you found this video helpful, don't forget to hit that like button and subscribe for more financial tips and strategies. And if you have any questions or want to share your margin trading experiences, drop a comment below. We love hearing from you. Thanks for watching, and see you in the next video.